off the press. Just went out live on Amazon this weekend. Called the Fairshare Model. For venture stage initial public offering. For initial stage, venture stage, initial point offerings as well. Just to start off by saying, John Weissman and I, last time we met, it was 6 years ago, we were in Berkeley at a crowdfunding conference. And we were both on the same team of a Oxford-style debate, sort of like NPR's Intelligence Squared. The question we were debating was, will equity crowdfunding and the Jobs Act benefit both entrepreneurs and investors? Ron and I came at it arguing no, and we had different reasons for it. Ron basically argued it was too complex for average investors and they were going to lose money. I argued that public investors typically get a bad deal, valuation-wise. And it was an idea I was exploring at that point about the difference between failure risk and valuation risk, which is really the cornerstone of the book. Failure risk is a risk that a company says it's going to do this, and it does something between this and a floor. Valuation risk is the investor overpaying for a position. And an investor can overpay for a company that hits all its marks. So my background, what I'm going to focus on is my work as co-founder and CEO of Fairshare. From 1996 to 2001, the company was around. We formed an online community of investors interested in direct public offerings, IPOs sold without a broker-dealer. We offered education on valuation and deal structures, member interaction. The idea was once we had a critical mass of members, we would offer free access to companies to pitch their IPOs, their EPOs. If they had a legal offering, passed due diligence, used our deal structure, and allowed our members to buy as little as $100. The business model was sort of a buyer's cooperative. Our revenue would be from membership fees and advertising. We would charge no commission. We wouldn't pull anyone's stock or money. What happened? Well, what normally happens to pioneers, especially in a regulated industry. The Fairshare concept was too early. We underestimated the time and expense needed to deal with the concerns of regulators. The dot-com and telecom bust basically chilled interest in new companies. So there was no offerings that were presented to the Fairshare members. We did have some accomplishments. We got 16,000 opt-in members, many more visitors. I learned to write about capital structures for people who weren't familiar with them. So in 2013, around the time this crowdfunding conference was taking place that I referred to, I resurrected the idea partially. The environment had evolved over the last 2 decades, where there was more interest in entrepreneurship and awareness of valuation, and there was more receptivity on the part of the regulators to look at innovative ways to deal with the regulatory structure. So my plan became to promote the Fairshare Model deal structure via a book. I couldn't get into trouble with regulators that way. To encourage funding portals, offering platforms, and broker-dealers to implement, and to make the Fairshare Model capital structures what Linux is to computer operating systems. In other words, an open system that would invite innovation. So every story needs a book. Every book needs a story. Here, my hero is the middle class, the average investors and the employees. The antagonist, the villain, is the way things are now. A conventional capital structure. And I'll describe what that is in a minute. The inspiration for this hero is accredited investors who use a modified conventional capital structure to reduce valuation risk. And I'll get into that in a moment. The conflict is anxiety about the future. Can the benefits of capitalism be fairly realized? The challenge is for the hero to recognize his latent power to shape markets by asserting his interests and to develop new skills. The Fairshare Model is a movement. The key to it is to adopt a unique perspective. And mine was that the IPO investors are most important. Tied for second place are the pre-IPO investors and the entrepreneurs. Third place, the secondary market investors. If you focus on the IPO investors, you'll have an intuitive sense for how the Fairshare model works. So the vision is average investors can invest in the IPOs of venture stage companies on terms comparable to those that VCs get. The goal is to reduce valuation risk for IPO investors and create an attractive alternative to a VC round for companies. Venture stage is a company that has these risk factors. And you can see they're all over the place. The key one is negative cash flow from operations, and it relies on investor money to operate. Many public companies have these risk factors in their disclosure documents. I'd say an overall premise that I have is that nobody knows how to reliably value a venture stage company. So a conventional capital structure used in most IPOs and some private offerings is defining qualities as a single class of stock. If you were to use a novel type approach, Three Musketeers would fit: all for one, one for all. The issuer sets a value for future performance when new stock is sold. So in other words, if I sell you half my company for $1, we agree implicitly that my future performance is worth $1. Pre-money valuation is $1. The problem is that I don't know, and you don't know, it's really worth $1. So pictorially, you can look at a conventional capital structure as raising equity capital in both private and public offerings for established and venture stage companies with no price protection, high valuation risk. A modified conventional capital structure is what VC and private equity investors use, so I call it the VC model for short. It's conventional in that evaluation is set on future performance at the time of the equity investment. It's modified by deal terms that basically provide deal protection or price protection for the investors. This kind of structure is used to raise equity in a private offering, venture stage company with price protection. Here are some examples of the forms of deal terms that provide price protection. The Fairshare model applies the idea of price protection to an IPO. It does that with a multi-class stock structure. It's the same kind of requirement that the modified capital structure has. You have to have more than one class of stock and deal terms. So put another way, the big idea is to replicate for public investors the VC model. This is what happens when you do that for comparative valuation risk. The vertical axis is valuation risk for investors, and you can see different types of capital structures. The conventional capital structure used in IPOs has the highest valuation risk. Modified conventional capital structure is lower, and it's a range depending on what the deal terms are. The Fairshare model for an IPO has virtually no valuation risk for new investors. The way it works is there's two classes of stock. Investor stock, I call it, but it's common stock. It's issued for money or delivered performance. Performance stock is a form of preferred stock and is issued for future performance. Both vote, but only the investor stock can trade. Performance stock can never trade. Based on milestones, the performance stock converts into the common investor stock. Voting control is shared between the investor stock and the performance stock, and you can see some examples of where both classes of stock have to come together and agree. The conversion criteria will be set by the company, described in the offering document, modified by agreement of both classes of stock. There will be variation based on industry, stage of development, geographic location, East Coast, West Coast, Texas version, personalities. Likely criteria will be a rise in the market cap of the investor stock, developmental achievements such as we built our product, we signed a strategic partner, we did something else that was important, got FDA approval. Could be financial. And interestingly, it could be also measures of social good. The implication of the Fairshare model for issuers is that they have incentive to offer IPO investors a really low pre-money valuation, a crazy Eddie low valuation. For example, let's assume that comparable companies are all valued at $100 million. Fairshare model, and a company wants to raise $20 million in an IPO. The Fairshare model would induce a company to say, we're going to go out with a $10 million pre-money valuation because we're confident that in the secondary market, that still gets closer to $100 million. As that happens, the employee performance stock is starting to convert into the tradable investment stock. Now, proportionally, the investors are being diluted. They're owning a smaller portion of that pie. But the value of their slice of the pie is going up. So it's a win-win. And the employees that are enjoying more benefit. Other implication is bigger, I think. The issuer has a competitive advantage in recruiting and motivating employees. Not only salary and benefits to be offered, but options on the investor stock, which has more upside than a conventional capital structure would offer. But then participation in this performance stock pool. An employer can say to company, potential employees, you'll participate in this pool, and it only has value if we as a team are delivering these conversion requirements. So the incentives to just adopt the Fairshare model vary by who they are. You can see a couple of groups here. IPO investors like it, of course, because there's less valuation risk. Valuation is decoupled from voting power. That benefits employees, the IPO investors, and the pre-IPO investors. The employees can earn more wealth than a VC would allow. The angel investors and the employees avoid a squeeze from new VC investors. There's a liquidity option, a secondary market ride influence on the stock, powerful motivation for employees to perform well, and the IPO shares can be distributed in a way to facilitate marketing goals that a company would normally use investor money to facilitate. So how does this story end? It's yet to be written. The challenges are there has to be a critical mass of investor support for it to be that's what this book is supposed to inspire. That will motivate experts in the financial ecosystem to come together and say, this is going to be a thing. How do we advise companies on how to implement the Fairshare model? And then there'll be some companies that try it. You're all familiar with the technology adoption life cycle and crossing the chasm. The Fairshare model has a chasm to cross, and that's the concept gap. The concept gap is right that you can see that in the middle there, where people are going to basically say, do they like the book? Do they like the idea? And that will encourage people to experiment with it. Over time, best practices will form. And my guess is that within a generation, no more than two, the Fairshare model will be accepted as a new normal for venture stage companies raising venture capital in the public market. The table of contents is there. It's a big book, as you can see. I've got an example, 2 copies here that people can peruse. There will be a condensed version coming out in a few weeks, about half size. So I encourage you to check it out. I post articles on different social media. You can see a few comments here from early reviewers of the book. Thank you.